There's a story I think about often. Whenever someone tells me they started too late with money. Someone I know didn't begin until his early 40s. No family money. No inheritance. Just a regular job. And a credit card he'd been paying the minimum on for years. About 15 years later, he had quietly built close to $800,000. In simple index funds. No constant trading. No big bets. No financial stress. At the same time, I watched someone else take the opposite path. Six-figure income at a young age. Smart. Ambitious. Always chasing the next opportunity. Always believing he could move faster than the market. During bull markets, he felt brilliant. But his account never really stabilized. Up. Down. Flat. Then repeat. By his early 40s, he had less invested than the person who started much later. And that difference points to something important. It wasn't intelligence. It wasn't income. And it wasn't timing. It was approach. One person saw money as a system designed to reduce stress in life. The other saw money as a game meant to deliver excitement. And here's the part very few people say out loud. Real wealth doesn't feel thrilling. It isn't loud. It isn't dramatic. Wealth feels quiet, predictable, controllable, almost invisible. And if you're starting from zero, especially in today's world, that quiet isn't a weakness. It's the goal. So the real question isn't whether you started early or late. The real question is this. If you're starting from zero right now, in 2026, 20 years from now, which person will you be in your own story? Because we're living in a very different environment. Interest rates are no longer near zero. Debt has become expensive. Home prices look more like typos than reasonable numbers. And behind all of that, an AI arms race is quietly reshaping the job market. Some jobs will disappear. Some skills will lose value. And many people feel uneasy, even while they're still earning income. In an environment like this, building wealth by chasing trends, gambling on big wins, or constantly trying to outsmart the market isn't just risky. It's exhausting. And I want to be very clear about something. What I'm sharing isn't theory. It isn't a strategy that sounds good on paper, but falls apart in real life. This is a playbook that's been used across multiple market cycles, low rates, high rates, and periods of real uncertainty. It isn't designed to make you feel smart. It's designed to help you sleep at night and still move forward, slowly and steadily, while the world stays noisy. And if you're starting from zero, that simplicity and calm is your biggest advantage. To avoid getting lost in endless financial advice, I always come back to a very simple framework. Think of your money as 3 buckets. The first bucket has a hole in the bottom. The second is the foundation. And the third is the engine that builds wealth. Most people make the same mistake. They try to pour as much as possible into the third bucket, while the first one is still leaking. And that's why investing always feels so hard. The first bucket is debt. Especially consumer debt, like credit cards. In 2026, credit card interest rates are not small numbers. 20%, 25%, sometimes even higher. If you're carrying debt like that, every dollar you invest is swimming against a powerful current. Here's something people don't like to admit. Paying off credit card debt isn't a defensive move. It's an investment with a guaranteed return. There's no stock, no fund that can reliably give you a 20+% return without the risk of serious loss. But debt isn't just about interest rates. Debt quietly erodes confidence. It makes you hesitant to ask for a raise, afraid to change jobs, tied to monthly payments. When you're in debt, you don't just owe money. You owe future freedom. That's why order matters. Investing while still in debt is like trying to accelerate with the parking brake on. You can move, but it always feels heavy, stressful, and easy to abandon. When you fix the leaking bucket, your cash flow changes. And so does your mindset. Eliminating debt doesn't make you aggressive with money. It makes everything quieter. Because clearing debt isn't an offensive move. It's a choice for peace. Once the leak is fixed, most people feel an urge to invest immediately. And that's where many good plans quietly collapse. Because between being debt-free and investing sustainably, there's a critical bucket most people ignore. Cash. Cash isn't an investment. It isn't there to make you rich. It's there to protect you from bad decisions. Think of cash like insurance. You don't buy insurance hoping it makes money. You buy it so when something goes wrong, you don't destroy your entire system. Imagine two identical investors. Same income. Same strategy. Same portfolio. The only difference is that one has cash reserves and the other doesn't. The market drops hard. 15, 20%. And at the same time, life happens. The car breaks down. Medical expenses. Or worse, job loss. The investor without cash is forced to sell. While the market is down, a temporary loss becomes permanent. Long-term growth gets cut short. The investor with cash uses it to survive. The portfolio stays intact. And when the market recovers, compound growth is still working. This is what online advice often ignores. Cash doesn't make you fall behind. It keeps you in the game. An emergency fund doesn't just protect your account. It protects your psychology. When you have 3 to 6 months of expenses set aside, you stop making decisions in panic. You don't invest on adrenaline. You don't sell out of fear. Cash creates space between emotion and action. And that space is what allows compounding to continue. Cash buys time. And time protects long-term growth. Only after the cash bucket is full does investing truly make sense. And this is where many people feel conflicted. Because the most sustainable way to invest is often the least exciting. Stock picking, options trading, crypto. They all promise control. A sense of being proactive. The belief you can beat the market. But the price of that feeling is usually stress. Constantly checking accounts. Reacting to news. Living on price charts. That isn't investing. That's putting your nervous system on permanent alert. Here's a hard truth. Even professional fund managers, with teams and massive data, struggle to outperform the market consistently. So when you try to pick individual stocks, you aren't being smarter. You're just accepting more volatility. Index investing follows a different philosophy. Instead of searching for the needle, you buy the haystack. You don't need to know which company wins. You just need to believe the economy will keep functioning. Over time, markets have built wealth for millions of people. The problem is, average is boring. No victory rush. No stories to brag about. No dopamine. And that's why many people can't stick with it. This is where a simple structure helps. I call it the core and satellite approach. 90% of your investments go into low-cost, diversified index funds. Automated and untouched. You don't optimize it. You don't tinker. You let time work. The remaining 10% is different. That's your curiosity money. Your experimentation. Your mistakes. If it wins, great. If it goes to zero, your financial life is still intact. This structure isn't about maximizing returns. It's about minimizing the chance that you sabotage yourself. Because if investing feels exciting, if you can't look away, something is probably off. Good investing should feel like nothing is happening. That's how you know it's working. At this point, many people think they've done everything right. Debt-free, emergency fund, consistent investing. But there's one major leak few people notice. Taxes. Many investors do the right things in the wrong accounts. And over decades, that mistake quietly erodes growth. Imagine two identical investors. Same money. Same returns. Same discipline. The only difference is where the money sits. One invests in taxable accounts. Dividends and sales get trimmed every year. The other uses tax-advantaged accounts. When it's time to withdraw, much more of that money stays theirs. The difference isn't stock selection. It's understanding the rules. One of the rare gifts in the system is employer matching. If your job offers a 401k match, that's free money. Skipping it is like turning down a guaranteed return. To keep things simple and quiet, you need a clear order. Think of it like a waterfall. First, contribute enough to your 401k to capture the full match. Next, prioritize a Roth IRA, where growth can become tax-free. If you have access to an HSA, it's one of the most powerful tools available. Triple tax advantaged. Then, go back and fill the rest of your 401k. Only after those buckets are full does a taxable brokerage account matter. This order won't make you rich faster. It makes the path smoother. Because investing without a tax strategy is incomplete. Financial quiet comes not just from choosing the right assets, but placing them in the right accounts. So far, everything we've discussed is defensive. Reducing risk, lowering stress, protecting what you've built. But there's a reality we have to face. You can't save your way to wealth forever. There's a floor to expenses. You need housing, food, transportation. Cutting has limits. And the daily latte story is often told as if it's the reason people struggle. But the truth is, you can't skip coffee your way to freedom in 2026. The real issue isn't spending. It's income. Income has no fixed ceiling. Skills can scale. And that's where real leverage lies. Many people turn to side hustles because they're easy to start. Driving, delivering, odd jobs. But these have one thing in common. When you stop, the money stops. They drain energy without building lasting value. Leverage skills are different. When you upgrade your core skill, you don't just increase this year's pay. You raise the foundation for every year that follows. Bonuses, retirement contributions, future raises. Just 1 hour a day. Time usually lost to mindless scrolling. In 6 months, you can be a very different person. Not because you worked harder, but because you became more valuable. The discomfort of learning is temporary. The reward can last a lifetime. Here's the connection few people make. When income rises, everything else becomes lighter. Saving gets easier. Investing becomes consistent. Anxiety fades. Financial calm arrives much faster when income keeps growing. If we had to simplify this entire journey, it comes down to 5 steps. No complexity. No secrets. Just the right order. First, eliminate the debts draining your energy. Not to be aggressive, but to quiet your life. Second, build a cash buffer that lets you breathe, so market swings don't force panic. Third, use the tax-advantaged accounts available to you. Not to optimize every percentage, but to avoid unnecessary friction. Fourth, invest the boring way. Consistent, automated, diversified. And finally, keep upgrading your ability to earn. Not to outrun others, but to make everything else easier over time. All of this rests on a simple truth. Math doesn't care about emotions. It doesn't respond to excitement. And it isn't persuaded by fear. Compounding only needs time. And you staying out of its way. The world will always be loud. News. Trends. Get rich quick stories. But lasting wealth is rarely built in a rush. It's built through small actions. Repeated over a very long time. Consistency beats intensity. Boredom beats drama. And quiet lasts the longest. If this made you feel calmer about money, then maybe you're exactly where you need to be.